I've seen a lot of clients over the particularly last 3 months this year really, who have been told really incorrect things. And it's really sad to say that about people in my own industry and my own industry in particular, but they've been told that they can't refinance or get borrowing because they no longer qualify due to the property price falling, or their income no longer services their current debt, so they can't refinance. I'm going to give you an example of 10 different clients that we've actually helped out over the last few months. And at the same time, it will be 10 things that unfortunately other brokers have missed. And these clients were told no, and we said to them, yes, you can do it. We ended up saving them a lot of money and also getting them cash backs as well. So without further ado, I hope you watch this video. I'm trying to keep it as concise as possible, but I think it's going to be really important, because if you've been told no, or you think you're a mortgage prisoner, there's a possibility that you're actually not, and you could refinance and save a lot of money. So please stick with this video. Number one, assessment rate. Every lender has a slightly different assessment rate. The lower the assessment rate, the higher your borrowing capacity. All right. So if I'm assessing you an 8% P&I versus 9%, you're going to be able to borrow a lot more. This might seem like a real obvious one, but there are lenders out there with relatively low assessment rates. Some of them are non-bank lenders as well. And so if your broker isn't accredited with these lenders, or ensuring that they are assessing you against these lenders, you could be missing out and be told that you're a mortgage prisoner. So that one might seem obvious, but it kind of is, but it isn't. Number two, overtime. We've noticed that some brokers are only servicing clients on between 50 to 80% of their overtime, which is in line with what a lot of lenders use. One client, we were able to get them to use 100% of their overtime income. Okay, so that meant that the client could refinance out, get a lower rate, and also cash back. Number three is rental income. All right, most lenders will use between 50 to 80% of the rental income towards servicing. Again, we negotiated 90% for this client, and they were able to service their current debt, and they could refinance out. Number four, credit report issues. All right, so late repayments, defaults, discharge bankruptcies, low scores. We had a client recently who was told they can't refinance out, they would have to go to a non-conforming lender. We looked at it and we realized that different lenders treat credit reports completely differently, and we were able to secure them a lower rate. Number five, too much information given to the lender. Now, I'm not saying that you should not give all the accurate information to the lender. As a broker, we have to collect a lot of information over a certain amount of time or a certain time frame. We have to fulfill a lot of best duty, interest, and compliance and everything. We need to make sure there's no fraud on the account, that you work at a real place, and that there's no gambling and all this sort of stuff. You need to be a reputable person that a lender can give a loan to. Now, in saying that, if a lender only wants 2 pay slips, just give them 2 pay slips. Sometimes people overdo it, and brokers overdo it, and they give everything in the kitchen sink, and that can lead to a credit assessor saying no. Number 6, household expenditure monthly, or known as HEM. This is everything from food, fuel, utilities, entertainment, insurances, you name it. Everything apart from mortgage repayments, and if you currently rent repayments where you live. For a couple that have 1 child, their HEM might be $4,500 per month as an example. We had a client that was told no, they have to stay where they are by another broker. We looked at their HEM and it was at $5,000 per month over the last few months, and we dug into their bank statements, and it turns out that he had a lot of one-off expenses at Bunnings because he was extending his veranda at home. We got them as one-off expenses, and we got his HEM down to $4,500 a month, and he was able to refinance to a much lower rate. Number 7, valuation and lender's mortgage insurance. So this is a big one at the moment as property prices fall. We had one client whose bank valuation was at $750,000 and their home debt was $635,000, and so that's an 80% loan to value ratio, 85% loan to value ratio. So anything over 80% incurs mortgage insurance, so therefore it defeats the purpose of refinancing if you're going to have to pay mortgage insurance. What we did is we researched getting a better valuation. And so we were able to get a better valuation, at 800,000, which means that the loan to value ratio was just under 80%, and we refinanced him to under 5% with a big cashback. Number 8, a speech pathologist was told that they were a mortgage prisoner because they were also in a lender's mortgage insurance or LMI territory. We actually dug into it and we found that there are a few lenders out there that will waive LMI for speech pathologists or speech therapists. We were able to refinance her and get her no LMI and a lower rate. Obviously, she was pretty happy. Number 9, self-employed people get a bit of a bum rap sometimes in regards to finance. We've had a couple of different people come through and they were told they need 2 years financials or 1 year's financials in order to get a prime rate with a top tier lender. That's actually not true. Some of the time, as long as your ABN is more than 24 months old, we can sometimes get it done for you. And in this case, we got it done, and this couple were happily refinanced to a much lower rate as well. Number 10, self-employed again. So when you're self-employed in the company structure in particular, there's things called add-backs, which things like depreciation, interest, excess super contributions, and also one-off expenses as well. We've seen a lot come through where sometimes certain add-backs have been missed, and different lenders allow different add-backs, or different lenders will not include company debt. So if you have a car loan in your company name, some lenders won't actually include that in the servicing as well. And so some of these people have been told that they're mortgage prisoners when in fact they're not. All right, so I hope you got something out of that. Thanks very much for watching the video. Please feel free to stop by wellingtonfinance.com.au. We've got access to all the lenders that you can imagine. We'll come up with strategies to help you consolidate and reduce debt as fast as possible. We'll show you how to pay off your 30-year home loan in 7 to 10 years. And if you've been told that you're a mortgage prisoner or you think you might be a mortgage prisoner, please contact us for a no-charge consultation, no obligation, to get a second opinion to see if we can get you out of mortgage prison, get you a lower interest rate, and maybe even a cashback as well. So feel free to contact us and we'll do everything we can to help you out. All the best.